So the better your accountant, the worse you look to a lender. I'm here with Kevin Wilson from Home Team Lending, and he's going to explain to us a few things on a program that I think is very interesting. I call it the cash flow loan.
Correct. Right.
Now, there's an official term for it, and what is that?
Well, we have a debt service coverage ratio, or DSCR loan, but it's
like I said, the cash flow loan.
Correct.
So that's the one you really want to think about. And the thing that I like about this program, and I think is something that most people don't know exists, is for an investor client.
Correct.
Right?
That's correct.
Or somebody who has maybe a lot of property and have sort of maxed out their capability of lending. Why is this a good program for those clientele?
Yeah, those are great questions. So a lot of times people that are investors, again, you get into the situation as Jack was referencing where you can't have more than 10 finance properties, and with a cash flow loan or a DSCR, you're capable of having more than 10. You're actually unlimited. It is a true investment loan. And as you stated in your original statement, there's no need for those individuals that are using a DSCR loan to talk about their income or divulge their income. As a matter of fact, the income from the subject property, the one being acquired, is what we're actually utilizing to qualify those individuals.
Okay, so let's back up on that. So what you're saying is we're not qualified. I mean, I know you have to have a certain credit score as the individual or the entity. Okay, but you're not looking at tax returns. You're not looking at bank statements. You are looking at what?
So we're actually looking at what the rental income in a monthly basis would be on that property that we're buying, that investment property, whether short-term or long-term. And then we're going to put that up against a ratio that we're going to build against the actual liabilities of that property. Same liabilities we would have with any property. So we're talking about the principal, the interest, tax, insurance, and associated dues.
So basic English, then basically if the rent covers after expenditures to pay the loan with a little bit of coverage and these other qualifiers, then that property would be appropriate?
Actually, we can do better than that. We can go below the ratio. So it doesn't even have to be a ratio of 1. So again, using very basic numbers, if the monthly rental was $1,500 and the mortgage or the total associated liabilities was $1,500, that would be a ratio of 1. We can actually go below that. The reason that exists that way is because investment properties in general are going to appreciate in time. So our lenders are willing to loan on them at a ratio currently below cash flow, but eventually towards cash flow.
Which is so interesting because you're actually talking about an inflationary ready loan that doesn't exist in conventional loans.
When you talk about conforming loans or what we call Fannie, Freddie, and Ginnie products,
no. Pretty brilliant.
It's an excellent product.
Very business forward. So then the other question I have is, this sounds great, and for somebody that's looking at this that wants to start building a rental portfolio, but they're self-employed and they have all those different issues.
Correct.
How is it best for them? What do they need to come to you with?
So we're going to do a standard loan application. The differential is going to be, we're not going to look at income from a traditional W-2 standpoint or tax return. We don't need any of that information. We're going to get the income derived out of this ratio from the rental itself, and we'll use that as the qualifier. We're going to pull and draft the credit, make sure that they're credit worthy. That credit worthy nature will tell us what percentage, what loan to value they can actually qualify for. If you have a higher credit score like a 720, you may only have to put 15% down. So that's, again, on an investment loan, that's a really unique thing, is only having to put 15% down if you have a 720 or above credit.
So if you don't have a 720, then we're talking more like a 2025?
Yes, sir, that's correct.
And then, so what are the other trade-offs, Kevin? Are there trade-offs in the ability to pay it off? Are there trade-offs in the interest rate? What are some of the limiting factors?
So that's a good question, and let's talk about the positive factors of it. So the loan itself can be a 30-year fixed. It can be a 5 or 7-year adjustable rate mortgage. It operates very much like a conforming loan, with the distinguishing piece being the income being derived from the property as opposed to the individual itself. So we have much more range of flexibility. The product, when finished, the loan itself, will look and operate very much like a conforming loan.
That's awesome.
It doesn't, in many occasions, a negative side, since we're going to lay the cards on the table. Many times there will be a prepayment penalty. Again, it may be, depending on the state, that may be 1 to up to 5 years, but traditionally it's about a 3-year window. So if you're talking about something you want to think about refinancing in the future, you need to take that into consideration.
So it's not for a flipper.
That's correct.
Yeah. So this is actually for building a rental portfolio, an investment portfolio this is really kind of what we're talking about.
Well said, Jack.
Or
that's exactly
adding
right.
on to an existing one where you're already leveraged.
That's correct, Jack. Absolutely.
Okay. Now, I know one of the great things about this too is you can directly close as an LLC. Explain that.
So on a secondary market, Fannie and Freddie or Ginnie Mae type products, we're going to be, those are for individuals. Mortgages tied directly to an individual. On a cash flow or a DSCR loan, we can actually close as an entity, so an LLC. Many investors already have an LLC or multiple that they're applying their investment properties into. We can actually close directly inside. This is a true loan for an investment.
But it is based on an individual's credit score, but then
Correct.
It translates in. So that individual is still in the line in that way for it.
So the recognition of credit worthiness, what their credit score is, still is in the same parameters like a conforming.
Okay.
But we're associating the actual purchase back to that entity if we go with an LLC.
Awesome. Is there anything we haven't covered that you want to make sure we cover?
I think we've done a pretty good job. You've got some really great questions.
Yeah, I think it's a great program, and I think that this is one of those things too. I did a small snippet on Instagram the other day about this because it's also, I think it's a very interesting thing. A lot of people don't want all of that looked at.
Sure.
You know, they don't really want somebody going through all that paperwork, and it feels overwhelming. So this is a really short. It does take some cash.
Yeah, so you're still going to have a down payment tied to it. You're going to have traditional closing costs recognized inside of that as well. So think about a loan just like you would on any other purchase. You're just deriving the income differently. There is one other piece, and I guess this isn't a negative, but it's a good piece to add on to it. The individual buying it needs to have their own primary residence. Okay, so
it's important.
It's an important piece. So
showing stability.
Well, it's showing stability, but it's also to prevent abuse of the product. It's meant for investment. It's not meant for owner occupied.
Got it.
And so again, you need to have that, and it's also not a great product for first-time home buyers, right? So they have to have an exception to do that. This is meant for somebody who already owns a home, whether financed or otherwise. And by the way, they can be a renter of their own primary residence and own another investment property. Once they're an investor, we can now continue using the DSCR program. We can also do cash out refis in seconds with a DSCR program. So a current investor can take their portfolio if they want to do cash outs to buy other properties or do improvements on properties moving forward. We can use the DSCR program for that as well.
And that sounds like a whole other segment. I love that though, because I think that this is really for so many, especially, you know, sort of a young professional entity, person, couple, family that wants to start building their portfolio. This is a great way to do that, especially finding it works well in Tulsa, right? Because it's easier to find those properties that you can actually rent that would cover what we're talking about. In a bigger market, this could be a little bit more
difficult. For sure, and with the ratios being down below 1, that you use, the bigger markets open up a little better as well.
Okay.
But here in Tulsa, we definitely have a great opportunity to utilize these type of products, the cash flow loan, to allow us to actually help investors get moving. Another great piece, and we didn't tie in, it's just a nice piece to add in here, is you can do these simultaneously. So again, because you're not encumbering your income into it, it's each property has its own income flow. You can do multiple simultaneous.
That's great. Great. So for those of you that are interested in a program like this, contact me or contact Kevin. It's a great program. I'd love to work with anybody that's wanting to start building a portfolio. And I know if you're a realtor and you have clients that are looking this, Kevin is your man.
So, be happy to help you.
Thanks.
Thank you, guys. What do you think, Ray?
Hopefully it recorded.
Maybe not.
It did.
It was a dry run.